I'm no long-term pessimist. I think we get through this. We got through the decade of the 70s, but there was a reckoning. People who weren't prepared, people who believed that their pension in 1970s dollars was going to sustain their lifestyle in 1980 had a very hard decade. So the idea that the renminbi or the yen or the euro or the BRICS could become the world's clearing currency doesn't work. I think the US dollar, in fact, will remain the reserve currency for the world. But I think US dollar hegemony will decline. And I think the prime beneficiary of that, or among the prime beneficiaries of that, will be gold. And by the way, I'm not suggesting that one denominate one's whole life in gold, but I think gold's market share, 0.5%, is ridiculously low.
Yeah, right.
Despite its strong performance, gold remains an uncrowded trade. Veteran investor RickRule notes that U.S. savings in precious metals are far below the 40-year average. The gold rally from $1,800 to $3,400 has been supported by central banks. The public is only now starting to step in, with bullion volumes rising from a pathetically low base. On a global level, gold's market share is still tiny, a clear sign that the real rally is yet to come. The current gold market surge has been significantly influenced by strong demand from Asian markets, particularly China. This Eastern-focused demand pattern differs markedly from previous gold bull markets that were predominantly driven by Western investment flows. The U.S. government has a choice between an honest default or a dishonest one by destroying the dollar. RickRule mentions they will choose the latter, repeating the 1970s when the dollar lost 75% of its value. He predicts gold will go 3 to 4 times higher as a result. The U.S. economy currently faces a challenging twin deficit scenario that creates significant pressure on the dollar and economic stability. These twin deficits, fiscal and current account, combine to create approximately 12% total deficit relative to GDP, an unsustainable level that drives exponential growth of national debt. The complex interplay between technology investment, resource requirements, and monetary policy suggests the need for multifaceted portfolio approaches that can adapt to evolving economic conditions, including consideration of the gold-silver ratio insights, which can be a valuable indicator during currency instability. According to Bank of America's private banking analysis, the dollar's weakness in 2025 may represent a longer-term structural shift rather than a cyclical movement. Holding gold isn't about getting rich, it's about protecting your wealth from a broken system. As we know, gold has compounded at 9% annually since 2000, while its market share of total savings remains remarkably low. Before we dive into RickRule's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Let's do the historical context first.
Okay.
Gold traditionally has done well when people are concerned about the maintenance of their purchasing power in fiat-denominated instruments. And I would suggest that people have reason to be fearful. The gold trade, despite the fact that, as you suggest, gold has done fairly well in the last 2 years, the gold trade has worked since 2000. It's important to know that. Gold has been up 9% for 25 years, which goes to your suggestion that it maintains purchasing power. In terms of the route forward, I think it's important to note that gold is still a very uncrowded trade. According to JP Morgan Chase, less than 0.5% of the savings and investment assets in the United States are denominated in precious metals or precious metal securities, with a 4-decade mean of 2%. So reversion to mean would give us a 4-fold increase in demand. Let's get away from that part of the math, though. Let's talk about the why. It is my belief that with the on-balance sheet liabilities of the U.S. government now exceeding $37 trillion, for reference, George, the gross federal budget, all the money that Fed takes in is $5 trillion.
The Treasury takes in, yeah.
Yeah, I mean, and the off-balance sheet liabilities, which are much scarier, Medicare, Medicaid, Social Security, federal pensions, that number, the net present value of unfunded entitlement liabilities, exceeds $100 trillion. It's my belief that the only way out of the debt and the deficits that we run is either an honest default, which I don't think is politically likely, or a dishonest default. A dishonest default, George, is what we did in the 1970s. The government allowed the purchasing power of the US dollar to decline by 75% over 10 years, which meant that while they honored the nominal value of obligations incurred prior to 1970, they paid them back with 25-cent dollars. Not coincidentally, in the decade of the 70s, when the purchasing power of the US dollar declined by 75%, the gold price increased by a nominal 30 times. I'm not suggesting to you, by the way, that the gold price is going to go up 30-fold in the next 10 years. I am suggesting that in the next 10 years, the purchasing power of the US dollar declines by 75% again. I think that's inevitable. Remember that since the year 2000, the gold price has gone up 12-fold already. It wouldn't surprise me to see the gold price increase mirror the decrease in the purchasing power of the US dollar. Ergo, if the purchasing power of the US dollar declines by 75%, the gold price over 10 years could easily increase 3 or 4-fold in nominal terms. The US government and US society, for better or for worse, has weaponized the US dollar.
Right.
There are some, quote, patriots in this country who think that's a good thing. I'm not among them. But in terms of the rest of the world, the efficacy of their maintaining their medium of exchange in a currency that the US government, should it deem to, can impound, is problematic. Whether or not you agree with Russia's decision in the Ukraine, there is no doubt that the US government stole $300 billion worth of Russian assets in the United States. That causes other countries that may have policy disputes with the United States concern. As little as they trust each other, I've come to learn they trust each other less. So the idea that the renminbi or the yen or the euro or the BRICS could become the world's clearing currency doesn't work. I think the US dollar, in fact, will remain the reserve currency for the world. But I think US dollar hegemony will decline. And I think the prime beneficiary of that, or among the prime beneficiaries of that, will be gold. And by the way, I'm not suggesting that one denominate one's whole life in gold, but I think gold's market share, 0.5%, is ridiculously low.
Yeah, right.
By the way, the statistics bear you out. The retail buyer, judging from positive cash inflows to bullion denominated ETFs, began about 20 weeks ago. The move that we have seen from $1,800 to $3,400, as you suggest, has been largely central bank buying.
Okay.
The bullion dealers in this country are delighted merely to see a bid, and so they will regard to you that volumes are surging. But volumes are surging from a pathetically low base. So what you say is exactly correct. Exactly correct. It's important to note that on a global basis, gold's market share, that is to say the market share of precious metals and precious metals related securities, is at about 1%. It's double US levels. The suggestion is that that occurs because institutional investors, retail investors, other people don't have access to as many opportunities as investors do, as investors in the United States do. And I think that's as good an explanation. For me, my physical gold holdings are all about maintaining my purchasing power.
Right.
That's what it's about. I've done an interesting exercise, George, beginning in the year 2000. I tried to reorganize my mind and my financial future in the year 2000. It seemed like an interesting exercise to do. And I've maintained a separate private ledger where I annually measure my income, my expenses, my net worth, my investments in gold terms as opposed to dollar terms. I live in dollars, but I've tried as a thought exercise to think in gold. And if you think in gold in the period 2000 to 2025, you're amazed at how cheap housing is. You're amazed at how cheap groceries are. You're amazed at how cheap
500 would be cheap.
it is. Gold has increased at 9% compounded for 25 years. And I think that reality probably begins over time to creep back into the equation. Remember, too, that I'm not talking about massive disintermediation out of US dollar denominated assets. I'm talking about reversion to a 40-year mean. I'm talking about the market share of gold climbing back up to the average market share in the period 1982 to 2022, which is 2%. JP Morgan Chase doesn't have data from 1981 or 1982, but they said that they surmised that the market share of gold relative to other asset classes at gold's peak, 80,
Right.
81, 82, was between 6 and 8%. I'm not suggesting that gold reverts, even in a nominal sense, to its peak valuation. I'm just suggesting to you that that asset class, precious metals and precious metals equities, reverts to the 4-decade mean. You can imagine, George, you have a better knowledge of the intricacies of markets than I. You can imagine the increase in nominal price that would be generated by a fourfold increase in demand.
The total market for gold, silver, and crypto is a pimple on an elephant. That small size, however, also sets the stage for explosive moves when even modest amounts of capital shift in. As gold prices outpace mining costs, the most efficient producers are reporting blowout earnings, with leaders doubling or more in value. This is the first phase of a classic bull market, and the best is yet to come. The gold and silver mining sector has undergone a remarkable transformation in recent years, evolving from a period of underperformance to becoming one of the market's standout performers. Both the VanEck Gold Miners ETF and Global X Silver Miners ETF have delivered exceptional returns, substantially outpacing not only their underlying metals, but also broader market indices. When that capital eventually floods into silver and silver stocks, it will be like trying to siphon water from the Hoover Dam through a garden hose. The moves will be undeniable. The silver mining industry features significant geographic concentration, with many major producers located in Latin America, particularly Mexico and Peru. This geographic concentration creates both opportunities and risks for investors, as regional political and regulatory developments can have outsized impacts on the sector. Let's get back to the interview.
I think alternative strategies will cause some disintermediation from traditional stores of value, but I note that the market capitalization of the precious metals sector and the market capitalization of the crypto sector relative to the totality of savings and investments in the world is about as germane as a pimple on an elephant's behind.
Right.
These are markets relative to the total size of capital sloshing around the markets that are irrelevant. They're relevant to you. They're relevant to me. They're relevant to that part of social media that doesn't revolve around pornography. But they aren't relevant as a whole.
Okay.
Do they compete with each other as speculative asset classes? Absolutely, positively. As do Beanie Babies and tech stocks and over-leveraged declining neighborhood, I'm being polite, real estate.
Right.
People will always speculate. The idea of something for nothing is extremely, extremely, extremely popular.
Mm.
My suspicion is that we are a very, very long way from that in the gold stocks. I've lived through 3 prior bull markets. And George, I'm not going to opine as to why they behave the way they do, but I can tell you how they behave. The market is led by gold. It's led by the fear buyer. And we saw that beginning slowly in what was probably a dead cat bounce in 2000, 2001, 2002, 2003. It probably recovered from those levels simply because it was oversold. We wore out the sellers.
Right.
But it's begun to pick up steam because of fear buyers. And that's how gold bull markets always pick up steam. I remember you and I having a discussion in 2023, and you said that some of your listeners had expressed frustration because the gold price was moving up, but the gold stocks weren't.
Yeah.
The simple explanation, which was true, was that the gold itself was moving up because foreign central banks were the buyers, and they don't buy stocks. An
Right.
asset class that didn't have a bid, of course, underperformed an asset class that did. But like in all prior bull markets, 2 things happen. The gold price increase, when it occurs faster than the increase of the cost of producing gold, leads to expanding profit margins for the biggest and the best producers. At the same time that the momentum established by gold validates the narrative for investors. And that's what we've seen. We saw no increase in interest in gold until about 18 months ago. And then we begin to see blowout earnings from the really efficient producers, the royalty and streaming companies, and the best of the best producers. And in the last 18 months, we've seen the best of the best, basically up 100 or 150%. We have seen the largest, most liquid companies that reported earnings quicker and that are listed on major exchanges, proxies for the metal, increase faster than the metal. What happens at this stage of the market now is that value arbitrageurs begin to see valuation disparities. They look at Agnico Eagle relative to something like Kinross or some intermediate producer, and they note that one trades at 1.2 or 1.3 times NAV, while the other trades at 70% of NAV. And the value arbitrageurs begin to go down market. So leadership goes from the best of the best to the best of the rest. And by the way, if it doesn't, mining's a capital-intensive business. The guys that trade at higher multiples take over the guys that trade at lower multiples if the market doesn't erase the disparity. As that momentum begins to attract the attention not merely of gold investors, but attracts the attention of the generalist investors, the market goes further down the quality trail to the single asset producers, to the developers, to the explorers, to the penny dreadfuls.
Right.
And somewhere, by the way, to get to your question, when the generalist investor comes into the space, attracted by the momentum, when the price action justifies the narrative, silver takes over leadership. I've watched it happen 3 times before. Silver itself, and then the silver miners. Reasonable quality silver stocks is so small relative to the gold stocks that the move is exaggerated.
Right.
And interestingly, and you've seen this as a trader, the price action itself comes in the psychology of traders to justify the narrative. And despite the fact that the silver price may double, making silver as a standalone asset class more attractive, the validation of the narrative means that people pile on in a way that they wouldn't if they were buying physical goods. I'm not sure why people are that way. I've just noticed in the last 3 bull markets that they have been that way.
Yes.
Financial assets are really odd. They seem to be the only, and I describe them as a psychological consumer good. They seem to be the only consumer good that increases its appeal as the price increases.
Yeah.
Again, I'm not sure why that is. I just know that it is true. Big banks, by their nature, probably loaned 1,000 different industries. And I would argue that they can't know 1,000 different industries.
Yeah.
Our bank will lend against asset classes that we understand very well. It amuses me that there's no chartered bank in the United States that will make what's in effect a margin loan against physical gold and silver. Some will. JP Morgan Chase will, with a $10 million minimum. They've ignored a fair bit of the market that's important to us. I consider gold and silver to be good asset classes.
Right.
If I have the collateral in my possession and I can sell it 24 hours a day, 7 days a week, collateral doesn't get better than that. In addition, both Frank and I have been talking to the gold community for 50 years, so our customer acquisition cost is very, very, very low. The probability that we're going to suffer a catastrophic failure at Battle Bank, lending to people we know against an asset class that we understand that's extremely liquid, is basically nil.
Right.
The point is that the specialization that's offered up by community banks, even if the community is defined by need as opposed to by geography, makes the banking industry as a whole more responsive to society while simultaneously being less risky.
Gold is generally not prone to big price swings or high volatility, but it typically keeps growing alongside its utility. This means that forecasting future prices of gold for the next 10 years is expected to indicate an increase in value, potentially resulting in profits for those making these predictions. According to World Gold Council data, mining cost structures have remained relatively stable, while gold prices have reached record levels. When the tide of generalist capital finally pours into gold and silver, will you be chasing once the market makes its most dramatic moves? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.